Regular finance meeting for Monday, February 12th. Otherwise known as Super Bowl Hangover Monday. Okay, let's see what we got here. Let me just make sure.
Roll call?
Yes, roll call. Sorry, I'm trying to find it in here. Donna Colson.
East Palo Alto.
Cutter from Idaho.
Hillsborough.
Leslie Ragsdale.
Jeff Ellis. Marty Medina.
Okay, great. Do we have any teleconference participation under AB 2449?
No.
Okay. We'll go ahead and open the meeting to public comment. These are comments of any items that are not on the agenda that any member of the public would like to make. So I see none here in the room. Any hands raised or previous emails? Fantastic. All right, I need an action to set the agenda and approve the consent agenda items, please.
So moved.
Thank you. Carlos, second, or who's that, Jeff, second? Okay, so we have a motion by Medina and a second by Alves. All those in favor? Can we do it that way today? Aye, okay, motion carries unanimously. All right, chair report. There's really nothing that I have to report other than the ecstatic nature of every person, every sustainability officer in San Mateo County who's finding out that they're getting discretionary funds to use for, from our surplus funds. We had a big meeting on limited, but
You have to apply. It's a program.
You have to apply, it's a program, but they can put their programs together under their discretion and figure out what they want to do. So we had our retreat, our goal setting session a month ago or a few weeks ago, and I think everyone, like our Citizens Environmental Council, everyone was just really pleased and so happy. And I really just want to thank you, Sean, for coming up with that idea. It was great.
I think it was a group effort. I know it was, but
Really good effort. So
We had talked at some point, there were like numbers and percentages or something for each town. I haven't seen that. Is that coming?
it's not out yet.
Okay,
Because
perfect.
we
So I didn't
have-
miss it.
No, you did not. We're waiting for the updated numbers. There's a little bit of a lag.
No problem. I just want to make sure I didn't miss it.
We have a webinar scheduled for the 23rd.
Yep,
of
I'm gonna be
February.
on that.
By then, we will have those updated numbers. I don't expect it to change at all, really, from what was out there in October, but we just wanted to do the most up to date. And just so you know, the member agency grants are available pretty much right after the 23rd. That application will be ready on a rolling basis. The local government electrification grant and loan is a little bit different, and that will be open just for a period of 6 weeks. So that has an annual kind of
close and open date.
application period.
So I think other than that, I mean, that's been the most exciting thing. On my own personal report out, I finally got a Tesla power wall put in, and it was a nightmare. It's just very hard to, it takes like just kind of giving some feedback on the whole process. So it takes like 6 months to get it adopted. They're super expensive. There's, even if you put the rebates and things, I think we're getting a federal rebate, small one. You get about a third back, I think, but they're still pretty expensive. So, and I could only do enough to take care of part of my house. I couldn't put the whole thing on backup. So it'll offload during the day through the solar system. We will use it at night. That'll be the normal routine. And then it will kick in to supply maybe half of the important things like the kitchen, like it could do maybe 2 or 3, but the sun comes out every day. So it will refill because I have a solar system. So, but it will do like the refrigerator, the stoves, the water heater, the basic stuff, that you really, really need. So that's great.
Congratulations.
Yeah, no, so if anybody's interested in hearing more about that or want to know the company we used, they were actually very good on the installation and all the paperwork and all the help. And they checked in every single week, Solar Semprus Solar, I think, but anyway, just I'm the guinea pig here.
I don't want to ask you exactly how much it was, but
Oh, no,
is it under $10,000?
No.
Just for the power pack.
One single Tesla power pack and installation was 25,000.
The third back, the third big.
And the third rebate takes it down to, you'll get about 7 or 8 out the back of it. So it'll be about 15 total,
Sure.
something. So, yeah, and that comes with next year's federal tax. So I have to, because I installed this year, just now, they couldn't get it in by the end of last year. So it'll have to wait and roll. So if you're putting it in with a solar system and everything, you can imagine it's gonna be a pretty expensive system.
Was the 6-month lifetime, was that PG&E, your Burlingame approval, fire
No,
department?
my approval came through pretty quick. It's the lag of just having the capacity to get out to see you,
Oh,
like,
Getting-
demand.
getting the person there, yeah.
and then getting the actual.
Yeah. Yes.
Yeah, so I think I ordered it in like maybe September of last year or something, August,
Yeah.
September, and then I just had it installed.
Good data point, thank you.
Yeah, no.
Sean, may I ask you a question on the meeting on the 23rd? I informed Nellie that I want to be there, but there can only be a certain number of board
Board
members, is that correct?
For Brown Act reasons.
I won't be there
Yeah,
because
so,
I'm out of the
I
country.
think Melly's keeping.
yeah, I just.
And it's
I-
sort of
I
first come,
Was
first
there,
served.
I just wanted to.
I'm gonna send my staff person.
Yeah, that's fine, it's just board members.
Yeah, perfect.
It might even be helpful to send out just another email to board.
It's a
members.
reminder.
Yeah, as a reminder, if you want. Now, all of our staffs can attend, we don't have a problem.
That's who we
And
really
that's who we really want,
Yeah.
right?
Yeah.
But still,
We love.
like, but Leslie was interested, she, might want to sit in on that.
Yes.
And for clarification. If a board member just attends and not says a word, then it's okay,
We
No,
tried.
No.
no?
I tried under
Okay.
the auspices of because it's informational and
Educational.
education, it's
Yeah.
not a discussion
Okay.
or whatever, but we still got word.
It is-
Don't speak on with your wife.
But it will be recorded, right? If you watch later.
I believe so.
Yeah, I think it's, so yeah, so if you get to, because I know I emailed you that I plan on being there and I know we have someone from staff, so if you get too many people and you need someone to not go, just let me know.
Yeah, I have a bunch of emails that I need to make sure there's no quorum issues on these smaller committees.
Yeah,
Right,
So I have to double check on that. We're great on the board, but I gotta double check
Yeah.
on these.
just let me know, I'm happy to just watch it, like, because I know we have someone, but I just not sure it's gonna get the level of attention yet, so that's why I want to at least be there or watch it, because they're like, oh, yeah, we did that. And I'm like, no, this is a big deal. So I just want to make sure, yeah, exactly.
100%, totally get it. Okay, that's really kind of it for item number 2. I'll go to item number 3, staff report.
Turn this over to Mick, our CFO, who's gonna take us through the rest of the meeting.
Thanks,
Yep.
Dave.
Sure. I'll also say I've slowly started to tweak this presentation a little bit, so I didn't want to do wholesale changes right away. Trying to make some of the font bigger, added a graph here and there, move some pages to the appendix, so just a heads up, hopefully it's not completely different than what you're used to. So staff report, as I mentioned in December, we were at the time finishing up transition to our sort of new investment structure, which this committee approved. We did complete that in December, moved the remaining funds to Chandler and Camp, which are new investment managers for us. As a reminder, Chandler is a longer term, not long term, but like 2 to 3 year maturity investor, similar to what PFM does for us. And Camp is more of a shorter term fund manager. One of the benefits of Camp is it gives us same day liquidity. So we can access those funds by the same day. So that's a huge difference for us and a great improvement, which takes me to the second bullet point is we are going to have a slightly different approach going forward because of the access to Camp that we have now. We're going to be targeting a pretty minimal balance at First Republic. We don't earn a return our cash at First Republic, our very, very small return we earn. And so given the elevated interest rates in today's environment, the inverted yield curve, we can earn about 5+% at Camp.
5.5 this last month.
Yeah, exactly.
Yeah.
Impressive.
Yeah, it's amazing. I don't know, who knows how long it's gonna last.
You're right, they're on the long side.
But it seems like too good an opportunity to let pass by, so we're gonna try and target, $5 to $10 million just for working capital needs and maximize our return. We did so, I think Andy mentioned this in one of the meetings, maybe in November. We did some benchmarking and found out that we are the only CCA that is rated by all three rating agencies, S&P, Moody's, and Fitch. And so we discussed internally, talked to our procurement folks, Sean and I discussed it, and decided there's really no benefit of having three. It's not huge savings, but we've asked Fitch to basically drop us as covering us. They are one notch below S&P. Talking to our procurement folks, we don't need really more than almost one rating, but I think it's nice to have two in case they flip flop and one's higher than the other at a time. But it really made no sense to have Fitch. Fitch only even rates, they have the least market share of the CCAs. They only rate us and MCE. And so I also talked to my counterpart at MCE to get his thoughts. And in the end, we're deciding to cut them. So that's $20,000 of savings. So just want to let this committee know.
Yeah, that's a good thing to do.
Two projects we're working on, both of which this committee is aware of. The cost of service analysis, we're continuing. We're going to present a summary of our findings and an initial recommendation to the executive committee in March. So more to come there. And the second big project we're working on is the prepay bond transaction, which obviously we're presenting today. So I won't steal any thunder from that. We are about to kick off our budget process in March. This is to set our fiscal year 2025 budget, and we're also going to refresh our 5-year forecast. So that will kick off in a couple of weeks. We'll obviously return to this committee with initial draft and then seeking final approval. And then just staffing updates. Andy Stern has officially transitioned on, so sad for us, good for him, I guess. But I think he's left us in great shape, so no concerns there. And then we have 2 open positions in finance, one of which we're actively recruiting for right now, which is a risk manager. This position will focus mostly on energy risk, given that's our primary risk, but they're also going to build out an enterprise risk management function. So we are about midway through that recruiting process. If anyone knows anyone, send them our way. It seems to be a harder position to hire than I would have thought.
So which one was that, the second one?
Risk manager.
Oh, the
Manager.
risk manager is harder.
Yeah, we
Could you
want,
send us what could you send me what the
Posting?
job description is?
sure.
I mean, I'm sure it's on the website, but just if you zip it out to us, I think
Sure.
it's a good reminder. And I'll post it, like we can all post it on our LinkedIn's and I can post it.
Sure, thank
on
you.
Our city website, our
Okay.
city newsletter.
Tricky one because we're looking for somebody who has energy, it's an energy risk really as the primary.
Yeah.
Well, let me send it to
So-
Haas,
That'd be great.
because they've got
You
that
never
whole.
know. That's right.
That friend is paying.
Hey, he might have
Yeah,
colleagues
we'll
and
take
staff.
any.
They're right, I can send it over to the
Be great.
hospital. I'll send it to a Dick Morris in this case.
Okay.
The second position, you want to just mention?
Second position is I need to work on the job description, but it's to focus on building out the staff. They can be a jack of all trades, so to speak, but the primary focus will be helping us on rates analysis, especially if we do consider updating our cost of service approach will be a key position. Okay, so into financial review. So first, load. Load continues to be slightly below budget, about 4% in year to date. It was actually 4% in the first quarter and the second quarter, so pretty constant. It seems that most of the shortfall is due to weather. And in residential, we saw a pretty mild summer, which impacted September, and then a warmer winter in November and December, which also impacts electricity, not as much as the summer. I added a graph here, so this is a new graph you may not have seen, just to look at the green line is actual. You can see it's below not only our budget, which is the dark blue line, but I also added last year's actual. So you can see we've been pretty consistent with maybe a few exceptions below budget. Nothing to be concerned about though. Onto revenue, we generated almost $100 million of revenue in the second quarter. That was about 16 million below budget. but this was obviously expected. 12 million of that variance was due to the rebate we gave in December. So we weren't surprised to see that. And the remaining variance was due to the lower load that I just referenced. So not a huge surprise, and what we were expecting. On cost of energy, second quarter cost of energy of about 70 million was in line with budget. But this was despite the lower loads. We probably would have expected cost of energy to be lower. So on a per kilowatt basis, costs were slightly higher than budget. We saw the same situation in the first quarter, and the reasons were the exact same reasons: congestion costs, as well as lower generation from our contracted resources. RA costs, which I think we've talked about in the past, we're largely on budget in the first half, but just to plant the seed, we are expecting RA costs to increase significantly versus budget in the back half of the year. So something we baked into our updated forecast, but you'll see that variance in the coming quarters. The net results of the revenue and the costs is we generated about $60 million in what I'd call profitability or change in net position. That is 10.6 million below budget, but again, a lot of that was due to the CARE/FARA rebate, so the $12 million there, slightly higher energy costs. And then we are seeing pretty nice savings on operating expense of about $4 million. Most of that's timing, so consulting costs, third-party costs, customer programs. Some of it's more permanent on the compensation side, that we had sort of budgeted for being fully staffed through the full year. And as we all know, it takes time to fill positions. So we actually are hoping that savings dissipates going forward because we want to fill the positions. The big variance we see, the benefit, which I wish we could take credit for, is the non-operating income there. And that's almost entirely interest income. So we generated almost $8 million in the first half of the year. I probably expect that to continue. We weren't, at the time, I'm guessing, who knows what interest rates were, what we were thinking, but we hadn't budgeted that. And so that's just a drop into our bottom line.
Is that realized or unrealized?
That's realized.
Realized. So did most of that come in the fourth quarter when rates dropped, or was that just
No, I think it was the fourth calendar quarter, and I think it's
just interest income on which accounts?
All
All of them?
of them. I mean, at the time we had, money market funds with Fidelity and Schwab, which were probably earning 4 or 5% now.
right.
So.
It's actually realized and unrealized.
Realized and unrealized. Okay. So probably some of that is interest rates came down last quarter. In the final quarter, interest rates dropped pretty significantly across the yield curve, especially on the short end of the yield curve. So I'm guessing since interest rates dropped in there, a lot of that, the interest rates were up like, what, Carlos, 6 to 8% on the short end of the yield curve, I think.
Yeah.
I mean, they dropped and created the returns of 6 to 8%. So some of that, is probably unrealized gain as interest rates on the short end of the yield curve dropped significantly.
Yeah.
Yeah, that's probably what that is.
Year over year, we're about 13 million higher than last year. So just a data point. So obviously in great financial position. The result of all that is cash. Cash is king. We have about $345 million of cash as of the December quarter end.
Or cash is regal in that non.
Yeah.
Oh, sorry.
Sorry. I learned in classes that I've certainly at Berkeley where somebody will say, it's regal.
Fair point. I apologize. Okay, sorry.
The youngins are ahead of ours.
Referencing my.
Yeah. Where it all goes anyhow.
Sorry about that. Okay, cash is legal. No, I get it.
But the alliteration is much better. Cash king.
Yeah.
So in my finance class, but you're right.
That's what I learned.
I think that's like a name of a check cashing service, right?
Yeah.
It's like,
Cash king.
We have to call them. It's not here,
Oh.
so.
I
don't know. Let's keep going and see.
Keep
what
going.
he says.
Okay, so $345 million of cash, which represents 351 days cash on hand. That is higher than our high end of our target of about 250 days, but I'll remind this committee that we are, great, I think maybe I was covering it up with my paper. The surplus fund committee, we did allocate $68 million. And only 12 million of that is showing up on the financials, the CARE para refund. So the remaining 56 million will be spent over the next 6 to 12 months. We also, as everyone knows, we decided not to increase rates in January, so that will impact cash a little bit going forward. That is the summary of the second quarter. I added some pages in the appendix, which you can read at your leisure. It seemed a little more detailed than necessary, but I wasn't trying to hide anything, just.
Yeah. Does anyone have any questions on this report?
I have a comment.
Yeah, please.
So I'd like to say thank you. I like how it's a change, it's different from previous reports, and I appreciate that you're looking at it and tweaking it. The font is definitely helpful.
You may remember this page had a lot of rows, more detail, so I tried to summarize it.
Yeah. So I thought I heard you say at First Republic, there is very little of a return and I think we had a similar situation in San Bruno with one of our accounts, and it was like, so do we look at changing banks if they're not really willing to provide a bigger return that we go shop around a little bit?
Yeah, so the money here, and it says 45.7, I've since moved a lot of that out to earn the return. These are operating accounts.
Okay.
And so they don't
Have
They don't have
They don't pay
right.
returns.
If-
the reason I say we ordered a slight amount is they allow us to offset our fees. Our
Okay.
fees are like $800 a month, so it's like
Sorry.
not enough fees to offset what we're earning. So we could, I know First Republic, and we've had money there before, has an investment account that we could move money back and forth, but we decided,
Too much.
yeah.
And you're still gonna be, like, even if we're on the very short end of the curve, if, that would create a lot more volatility in the value of that account, because if interest rates rose again sharply, then we would lose money in that account. And I think the idea with that account is we always kind of know what's in there.
Right.
We know, we know we've got these bills out. We don't want to wake up one day and find out the account value is down below what we are transacting. Okay.
Thank
Yeah,
you.
and for a while, we were keeping about 25 million in that account for operating expenses, but now that camp is same day liquidity, then it makes sense for us to
Got it.
just keep it at a healthy but minimal level.
Yep.
This guy's right on top of it. I appreciate it.
Yeah, this is one of the tables I tweaked more than others because I thought it was hard to read before.
But all of the
It's really
detail is
helpful.
there
Yeah.
in the appendix.
And the other thing I want to ask, if it's all right, is there's pages 19 and 20, and they're like little summaries of what's gone on. This was asked for by a previous board member who's Charles, who then quit is the minute he made the staff do all this work, then he moved up. Charles, supposed to see him today. No. I mean, I do too. It's just hard when, I just want to make sure that people are still getting value out of this and see how much work it is for the staff to do. And understand if, I think they put them in every monthly meeting packet at the end.
Sorry, which
It's
one?
pages 19 and 20.
Oh, these pages and stuff?
charts.
Yeah, hey, no, yeah. Ask Andy that question, and he mentioned that there was a prior board member who had asked for it, and so I was gonna baby step think about tweaking these pages or pulling them out, or I don't know if people find them value. They don't take a ton of time, but I don't know if they add a lot of value.
They're in the packet that went up this morning.
And they're in the back appendices, very deep in the regular packets that go out every month. I guess I'm just saying, if people aren't looking at them and it's taking our staff a few hours to do them, I'd rather give our staff back their time
Agreed.
and let them focus on other things that are more value added.
I would defer to you because you're the detailed person, so if it doesn't work for you, then I don't see. why we would
So let
need
me
it.
say that I think it is helpful. And you graphically, you can see how large the commercial industrial piece is, right? Right, and that's like, oh my God, it's only 9% of our customer base, however,
Right.
it made them 59%
Of
of
our revenue.
our revenue. I mean, that's a very intuitive.
Counterintuitive.
Yeah, that was in the packet that we got ahead of time.
Yeah, it comes
I remember
in
that,
the,
yeah.
the write-ups, yeah.
And
So, I don't know.
would quarterly be sufficient instead of monthly?
I think we just do it quarterly.
Oh, we do it right now quarterly, okay, and it's still,
And thinking back to when Charles was making these requests, I think part of his point was he wanted this to be available to the public.
Right,
Like it wasn't
Right.
just for Charles. and
Having
board
to
members. It was
search, yeah.
actually,
right, yeah.
people could- anybody who looked could see this quickly. That was his point, which is probably still valid.
And thinking of it in that way, in terms of the public, like, you know, for me being less detail oriented, I like the pie charts.
well, they're
And-
showing different things.
Yeah,
The one up on top is the sort of annual history of our audited financial statements and the net position. So you can see when we started in June of 2016, we were at a negative 1 million. And you can see the growth over time. And then the unrestricted cash balance is the next. So it shows also the cost of electricity. They are interesting from a trend line perspective. So, yeah.
But you know, I also find weird is the yellow one, it's not apples to apples, because it's 6-month data,
Yeah.
and then you're
Right,
comparing.
right,
So I,
so you're looking.
I mean, the cash and.
Could you tweak it maybe? just
Yeah,
to make
it was on my
easy?
to-do, yeah,
Okay.
no, I agree.
Yeah, no big deal. I just wanted.
As long as
to
there's
bring
no pride, you know, if you guys.
No. You take a look at this. I think the trend lines are important, but to Leslie's point, maybe a more interesting trend line is a graph rather than all the money dollar, like all the dollars. Maybe these convert into
Yep.
graphs or some sort of
Okay,
a
let me take it.
dashboard that people can look at or we can look at. So take a look at it and just think about that.
people love a dashboard.
Yeah.
These were fine, I was just doing the math in my head and I was looking and saying, okay, are we, where are we in 6 months to a year? But you're right, I guess if we're in a.
One quarter, it looks
Yeah.
weird.
Yeah, so if it were in a more graphic form, it'd be easier for people to see, but how much time does it take staff to put this together on a daily basis?
Yeah.
Yeah.
Change.
Yeah, right.
Yeah.
You gotta make up your numbers every time.
Into another page, because as these get longer and longer and longer, I don't think you want to lose the historic data, because I think that is interesting, but I think Leslie, down the road, if this were to be able to be made into a dashboard so that you could look at like 1 year or 5 years or trends and you could run graphs, would be kind of interesting. Like it could just be sort of in an Excel spreadsheet some way. Not even that we have to see it, but just so you can see it, or if it's important for the public to see it, how would that look for the public? But anyway, it's just something to think about now that we have almost, 7, 8 years of data. It's starting to make a trend line.
Yeah.
Okay. All right.
Anything else?
Perfect. No.
Okay.
Are there any members of the public who would like to add comment on staff or chair report? No one here? Okay. I have to fool around with this because I don't have a paper copy right here. Oh, Leslie's gonna help me out here. Okay, thank you. All right, last item on our agenda is, just overview of the prepay bond structure. And it's just a discussion item. Turn it back over to Sid.
Okay, so that was the easy conversation.
Yeah.
Discussion and direction.
This is a little more complicated, meaty. So as a reminder, it was before my time, but Garth from MCE and CCCFA presented to, I think, this
Yeah.
committee in June. So some of this is a little rehash, but refresh our memories. It's a pretty complex topic, at least I find it complex. So hopefully you find that helpful. I don't mean to retrash old conversations. But we have been spending a fair amount of time on this topic and wanted to come to you to seek a little direct, give you our initial take. Maybe it's more than initial, but our take, and then seek direction on sort of next steps. Before I start, I was talking to Sean about this. I do want to caveat, at least it was confusing for me, that I think the name of this structure is inaccurate. It's not a prepay. When I started, Sean said, "Will you look into this?" I was thinking, oh, you prepay for something, you probably get a discount.
Yeah,
That
that's
makes
what it
sense.
sounds like.
But it's not. At least we are not prepaying for electricity, PCE. Our PPA event suppliers are not getting paid in advance. There is some prepayment going on in between structures that are set up, but for our purposes, there's no prepayment going on. So I think that for me took a while. Like I kept saying, like, well, where's the prepayment? I don't get it. And so I would just put that out there because you might be thinking prepay the name. I talked to the banks and they were joked about how they've tried to rename the structure and it just hasn't caught on. But basically what it is, and I'll go through a fair amount of detail, but it's a structure that's basically been blessed by the IRS that lets tax exempt entities like ourselves access the tax exempt market and leverage that savings to realize savings in our procurement costs. And it's entirely driven by the savings between tax exempt rates and taxable interest rates. So that's just, I'll put it out there. That's sort of like the punchline. I'll go through a fair amount of detail.
So, Nick, that sounds like an arbitrage.
It is
And
exactly that.
And when you're in finance class, particularly public finance class, that is a freaking no.
It is
So I assume that there are legal opinions that say it is fine. I mean, that is, and we spoke with Garth actually down at the CCA conference, right? And it began to make sense to me, but I continued to push that, like, where are the legal opinions? Like, are we sure that we're not gonna get a clawback, 10 years from now when the IRS says, oh, guess what? And I'm not a tax attorney, right?
No.
It's just,
You've hit the nail. It is legal arbitrage. It's exactly what it is. It's been blessed. It's one of the few areas within finance that this is allowed, because usually you think of that as a no-no.
Yeah.
But it's legal arbitrage that has been blessed by the IRS. There's been, I try to, comfort, you get comfort with masses. There's been $88 billion raised in this market. There's been all of our peers in CCA world have done it. So a lot of them. Could the IRS maybe come back? I don't think so. I believe there's legal opinions, tax opinions, but it is arbitrage. That's exactly what it is. And you could argue, why do they do that? But the government gives out these freebies, so to speak. And so we are there to hopefully take advantage of it, or it's an opportunity for us.
Sure.
So I covered a bunch of the topics already on this page. It's been codified in the tax law. IRS allows municipal utilities, which CCAs are considered, to borrow in the tax exempt market to prepay for deliveries. Again, we are not prepaying for anything, but there's a lot of schematics, boxes set up that allows this to happen. The structure leverages this advantage that IOUs do not have. So PG&E does not have this advantage. And in the current interest rate market, it's about an 8 to 12% savings on our PPAs, or the cost that we put into this structure. And I'll talk a little bit about what that is in dollars and cents. Again, I put it in blue, green and bolded. This savings is entirely based on the spread between taxable and tax exempt interest rates. And that is in today's environment with high interest rates, that's a pretty big difference. It's about 100 basis points. It's not always going to be the case.
Can I ask about that too?
Sure.
So if the critical thing is to spread upon the day that you issue the securities.
Yep.
So if spreads change down the road, it doesn't impact you because it's the arbitrage on that single day.
It's on that day.
Mhm. Okay.
And are you doing one single issue?
That's a good question. We are proposing, you would do one initial transaction. Several of our peers have done multiple. So MCE has done 2, Silicon Valley just did their 3rd. So you're not limited to one, but first would be one transaction. The other aspect about this, it's a little complicated, is you are actually only doing a bond for 7 years. These are 30-year structures, so you're locking in savings for 7 years. In 7 years, you have to do another deal,
Right.
and the markets could be different. They could be better, the spread could be wider, or the spread could be a lot less. And then you do an assessment and say, does it make sense in year 7 to continue?
But if you don't continue, there is no prepayment penalty.
No,
There's no penalty to not continue.
Right, this fall, you'd only get the savings for 7 years. It sort of the transaction reverts to the old way.
The other thing to say about it, and then back to you.
Sure.
Is that it's a single issuance, but, you know, we would have potentially 3 power purchase agreements running through the process, which is how you then figure out what your savings will be. So the more PPAs that you're running through it, the greater the potential savings. I think that's why East Bay and others have done multiple rounds of this, you know, just.
Adds to the savings,
Exactly right.
10% on higher dollars.
Yeah.
So, but we would not.
So you're essentially amalgamating the cash flow patterns of these PPAs into one
Structure,
diversified bonds at one structure.
correct,
Mhm.
exactly. Last point, just to reiterate, there's been, you know, these are well-used structures. It's very complex and a little black boxy, but I am comforted, excuse me, that these have been around for a long time, you know, almost $90 billion. And as I mentioned, there's been 10 billion issued by our peers here in California. And I put a page in the appendix so you can see who those are.
So. Okay, all right, just continue on.
So this page, I will try and summarize, and I will caveat that I'm learning a lot about the structure myself. As we move forward, I'll get more and more educated, but this is a schematic of the flow of funds. It's kind of complex. Maybe it's not necessary too much detail, but I'll try at a high level, walk through the various numbers and.
Study is intermediate.
Yeah, it is. It's a good point. So, and it's not this, things don't happen in this order, but it's I think hopefully helpful to explain it this way. So the first thing I'll say is the debt issuance. So that's number 1. CCCFA, which is the Joint Power Authority, will issue the bonds on our behalf. They issue them to Fidelity, Putnam, Wellington, Capri, whoever your familiar names are. These are tax exempt investors. We raised that in the public market for 7 years. CCCFA then takes those bond proceeds, and they're the ones who are kind of doing the prepayment, not us again. They prepay for the electricity. They send the money. They take the $500 million, just to use an easy number, and they give it to this prepay LLC, which is just a entity that's set up to make this all happen. Prepay LLC then takes that money. They don't want to sit on the money, and they loan it to someone who needs money. Here it's called intermediary bank. It could be an investment bank. It could be Deutsche Bank. It could be investor. It's lent to someone who wants to borrow money, but in the taxable market. And so they're borrowing at, say, 5.5%. And so again, that is that arbitrage. So money goes from fixed income, tax exempt investor up to CCFA and over to intermediary bank.
Okay, and it's an unsecured loan?
It says upfront. What does that mean by upfront?
I just mean on the first day, like
Oh,
the day,
okay.
the day
All
it
right.
happened.
Schedule, okay, so what I'm trying to figure out, and I know Carlos is working on this too, is where the risk points are in this, you know, so if you raise the money, you send it, let's just, what if the intermediary bank or the bond defaults?
If the intermediary bank goes bankrupt, Lehman Brothers would be an
Yeah.
example, the transaction goes away.
Silicon Valley,
Silicon, they probably wouldn't be an investor, but yeah.
but whatever.
Yeah, if the bank goes under, transaction goes away, we don't realize our savings, so maybe it happens 1 year after we've done this deal. Worst case scenario, we've paid, you know, we spent our time, we spent some fees and we don't get savings, but there's no recourse to PCE. The debt is not on our books. We are not obligated to pay anything. There's no risk, no harm, no foul.
Just goes back to our regular PPA
Yeah.
payment.
Goes all,
And are we sure that there's no way to pierce that veil?
I mean, there's a whole page on risks, which we can get into. I have asked, because as that Sean and I discussed, it almost seems too good to be true.
Well,
And for-
that is always the problem, right?
And so-
This is like.
They
the-
did that about CCAs too, just a
Well,
reminder.
Yeah, but Sean, to be honest, on the finance side, like investment banks make a lot of money on these deals.
Yep.
They're doing it because they want to make money.
course.
So if you take something like securities lending or pension obligation bonds, which were the hot things, unfailing, no risk, can't lose. They all lose, they all can lose. There is a way for this to go wrong, I promise you. But we just have to figure it out
I mean,
and understand that risk.
I have asked all the banks, lawyers, I've talked to the CFOs of most of the CCAs who have done this, pushing and prodding, what am I missing? Why wouldn't I do this? Seems too good to be true. And
And it could be, I mean, it could just.
And
really
you know,
be,
I
but-
can't say, it doesn't seem like there's a risk to PC. There's a page on risks, which I don't even know if I
We'll go
call them
through it.
risks. But this is non-recourse to us. We are not obligated to pay the bonds. You know, again, I'm not a lawyer or tax lawyer, but it seems like there's very, very little downside.
Again, has it been tested in the courts? Has somebody
Well, there's
failed?
been $90 billion of.
No, but has there been a failure of it? I
We
mean,
should check
because
into that.
this
I don't
is,
know.
so this is like, if you look at like, say, for example, securities lending, it was sort of the same thing. You were able to take all your securities that you held in your pension portfolio. You loaned them out to short sellers. They were collateralized at 105, 108, right, %, Carlos? And then you were making this arbitrage on the income coming in. The issue then was when the short sellers defaulted and never handed back the securities, and they weren't collateralized high enough, there was a gap and you could lose money in securities lending. So there always usually is something, so the risk to me would be somehow the court allows them to pierce the veil. And like you have this LLC, you know, somehow
Yeah.
someone in the court system says, you can't, actually the real holder here is PCE and it's, you know what I'm saying?
Yeah.
I mean, I just wanna make sure. we
I
check
get it.
on all
I
that.
mean, I have, you know, there's a lot of fees to be made here. There's hundreds of pages of documents in each of these structures and arrows. And
Yes,
so I have
and the
not
offering and everything.
read them, but I am told that these are non-recourse. I mean, there's a lot of
Okay.
project funds, non-recourse to
Yeah.
PC, no risk.
Okay,
Can I personally vouch for it? Probably not.
or we just can't, we can say it's not, you know. Okay, we'll move from
We
there.
can also decide that the potential savings is not worth it, or decide that the potential savings is worth it enough so that if it were
It
to
offsets
come back,
risk, yeah,
we'll
yeah.
be clawed back later, you know, maybe there's, it comes out.
I mean,
reserves.
it makes a ton of sense and it's basically like a tax giveaway to us, which
Yeah.
I don't really understand why the IRS is doing it.
I've
And we're
asked
just
that.
taking care, but I'm not gonna question that.
Yeah.
So I get that. Okay, keep going, sorry.
Um,
Go ahead, Leslie.
I always ask the very basic question. So under this system, at what point does money leave PCE's accounts?
so it hasn't yet in sort of in the 1, 2, and 3, it hasn't happened yet. It's a good question. So money's raised from investors, goes to CCCFA, then goes over to the people who want the institution that needs the money. What we do is we just every month, we continue to pay our PPAs. We have, and that's, you know, like number 6 at the bottom, but the project participant, which is us, I put our little logo up there on the upper left. We then, on a monthly basis, as we normally do, we just pay our PPAs, but we pay a discounted price. I put it in green because it's money and bolded it. And that's all we do. We pay each month as we normally do. There's a little more complexity. That's one of the only negatives that I've been able to uncover because we have to pay like 3 different invoices and it adds to the process. Maybe not a reason not to do it, but that's all we do every month.
But our PPA is no longer with, just for example, you know, Wright, Mustang, it's no longer with our 3 projects. Our PPA is with this CCCFA. You know, it's just, it's one PPA that could cover, you know, in theory, you know, a dozen different projects
Yeah.
that we're gonna cover.
And the counterparty for your PPA has to agree.
Right.
Yeah.
Right, and so now there's a stable of developer owners on the other side of these transactions who have agreed, but you know, that becomes part of the discussion as well.
So CCFA sells, we buy our electricity then from CCFA.
Yeah.
And what is the legal structure guaranteeing us the right to all of that electricity? That's in the prepay LLC?
You know, you're probably getting above my league. I'm not sure the right.
Do you understand that, Leslie?
There would be the agreement.
What I'm saying?
Yeah.
As a lawyer? Okay, so, oh, Jen, yeah, good, yeah. So Jen.
Hi, everybody. So I'm not a tax attorney. I want to say that first and foremost. I think that what we do need to do, and I'm hearing the concern that the members are raising, that it would make sense for us to get a formal tax opinion from our tax attorney. And that way they could quantify risk and give us a formal memo on the topic that would be answering a lot of the questions that are coming up today.
Great.
Sorry.
Go ahead.
What was the name? He's living with Woodside. He works for, is an attorney in this area. His firm, what's that? Yeah. I'd be interested in maybe reaching out.
Who's that?
So.
No,
Daniel.
Daniel Yost,
Oh,
right. Yeah, one, he worked for work. Yeah, so anyway, huge.
On the board, right?
Right, yeah, correct. And they were doing a lot of.
Yeah, Oric is one of the big players.
Yeah,
which
yeah.
I'll go through in a second.
So I mean, I agree, and I don't think that we should skimp on Ben. Like, I really want a tax letter that is, you know, pretty solid, right? And that comes from a firm that really has experience.
This may not be exactly what Jennifer's talking about. I know to do a transaction, we will get a tax opinion.
Yes.
You know, that's will happen. Maybe we want advice before we begin further, but that,
Yeah, yeah.
like to do the deal has to.
Yeah, have a tax one.
Yeah.
Jennifer, kind of what I was thinking, so we're bundling up the energy, essentially selling it, so the CCFA is the intermediary, right? On the whole thing?
They're one of
They're the
intermediaries.
intermediary, okay. So I guess the question becomes, we have an agreement to sort of essentially CCFA sells PCE, all assigned electricity delivered by the prepay LLC. So it's bundled up in the prepay LLC. They are the intermediary. I want to understand also, I'm sure we're going to have detail on this, the fees, but then when they resell to us, is there any way that can be broken? In other words, if somehow we can't access that through, in other words, if these guys, if the
Like
intermediate.
send us our power and they say, no, sorry, we're sending it somewhere else, or.
Either they're sending it somewhere else, or somebody makes a claim on the intermediary bank, or somebody, what's underlying, you know, they have these quote unsecured loans to us, but are they secured back to the electricity? So if you
Yeah.
default, then can you do, I mean, I just want to understand that whole transition.
Okay.
So one example there, when we first started, we were contracting with mostly, I think, Constellation was
Mhm.
one of our first suppliers.
Yeah.
So we had a PPA with Constellation.
Yeah,
It was just with Constellation. So I mean, they could have hamsters on treadmills somewhere. It didn't matter where the electricity came from. But the agreement was we buy the electricity at a certain price. And so they had all the sort of contracts, warranties, et cetera, that they would deliver the product. And I mean, if they failed, our recourse would have been with them. I think that's the first step we're sitting on this time. So that's like our agreement where they become sort of, you know, a version of Constellation for us. And our agreement is, you know, they give us power, we give them money. If they fail, they're, you know, seriously liable to us for, you know, this.
okay, so let's just say if they fail, let's take the if they fail scenario. If they fail, we've gone from having an immunized portfolio, if you will. Like we've got this portfolio designed. If somehow it failed and now we had to re-procure while we sorted all this out, that's the risk. The CCFA. So somehow if CCFA couldn't, you know, if they somehow failed, like the recourse isn't back to us, but is there recourse back to them? I mean, someone has to somehow these bonds have to be secured. So what's the securing instrument in these bonds? And then is it recourse back to them? And if somehow they failed to deliver electricity because a judge came in and said, we're gonna hold, the tax implications I'm not worried about. That doesn't seem like the risk because we're a non-taxable entity. What I worry about the risk being is we turn these contracts over to them. They then immunize them here.
Yep.
This is the contract
Mhm.
that they have the bonds. These bonds are backed by something.
Yeah.
They're backed by the payments. If something goes wrong, like an earthquake and it ruins the whole, and then there's no more electricity generated out of that contract,
Who
then
pays us?
who pays us? Yeah, and
And where do we get our profit?
the risk we have is if somehow that chain broke down and we had to go back in and procure in the market at a much higher rate than we had already procured.
And how is that risk? Just a follow-up question would be, how is that risk discernibly different than the risk we already hold?
Exactly.
That's what I was
Dealing
gonna say.
Exactly.
with
We
the
have that
PPA
risk anyway.
Yeah.
Yes,
But-
exactly.
But understanding kind of instances.
Well, yes, and so the bonds are they're unsecured. I guess I wanna understand that a little more, what is the bond? I'm buying bonds, okay, so I'm buying a cash flow stream, right? So I'm paying you today for a guaranteed, City of Burlingame issues bonds on our community center. We guarantee $1 million payment a year for 30 years. So these guys are getting the payment, we're paying them, they're paying them, it's arbitraging. Is there any risk in the breakdown of the payment process scheme? Or if something happens to one of these, like Right or something under there, how do we backfill in our supply? And
Yeah.
exactly, Sean, is there a delta on that risk? And then if they're unsecured, we're not liable on that end for the bonds. But if the bondholders, if something happens here, if we couldn't make our payment, we could go bankrupt and not make our payment to the CCA, who then couldn't pay the bondholder. That's a possibility too. And then I'm just trying to understand those risks. I'm not worried about really, like somehow this becomes a taxable event
Right.
for us.
Probably, I mean, I don't know the answer to all those questions.
We can just,
I've been-
It's the same due diligence process we went through when we contracted with council.
Yeah.
It'll be a new
Yeah.
entity who will have their own portfolio. Yes.
I've asked at a high level some of those questions, like, what's the risk? What if things go bad? And I've been told, which are just words from non-lawyers, that there is no risk. But my point is, I think one of our recommendations is to hire legal counsel and probably present to this board or get more questions.
I would hire,
She wants bankruptcy counsel.
I want almost like bond counsel. Like, I would love some sort of an outside independent investment bank not involved in this to look at this and say, where would the risks possibly be? Like yeah, I guess there's tax counsel and then there's deal counsel.
Yeah.
I want deal counsel.
Yeah.
Where are the risks in the transaction?
That's fair.
Yep, okay. And there's a lot of lawyers involved. And there is bond counsel involved, there's tax counsel, there's underwriters counsel.
Yep.
So, and what's interesting is even with, the transaction costs are relatively high, because you have all of those.
A lot of people are.
I mean, everybody has
at
their
the
own
drop.
counsel, we know that's right, we know that's right, we have underwriters, right. So, I mean, clearly there's some money to be made here, but, I want to understand the electric supplier piece, so that's an entity, completely new entity that gets sent up, well, it's not completely new, it already exists, or for every issuance, we set up this electric supplier prepay LLC.
For every issuance, this issuance, I don't know, I don't think it could be levered if we did a follow-on transaction, I haven't gotten to that point, but. Yeah, I think it'd be a separate one, but if we put one PPA in there, or 3 or 7, it's all our PPAs are assigned to this entity.
Yeah, and we're not commingling ours with other, unless
No.
there's a joint issue, has there ever been a joint issue?
There is, yes, that's good. The first one was a joint issuance, just for economies of scale, Silicon Valley and, East Bay, Ava did a joint issuance, the first one. I'm not proposing a joint issuance, so there'd be no commingling of other people's PPAs and ours. There are a lot of fees here. The net number of 10% nets out those fees, but people are making money. I'd be lying. There's lawyers, there's bankers, there's savings from that 100 basis point spread I said. Our goal is to get most of that savings, but the bank, the other financial party that's borrowing the taxable market, they're gonna realize some of that too. So we.
What is that number? Do we know how many basis points that is? What we net clear? So if it's 100, that's there, then there's gotta be like 12 basis points or 15 basis points of cost.
Well, the fees are about 100 basis points, 1%.
Okay,
That's
so
fees
1%
to-
on the like, we're getting a spread of 10, call it.
It's 1% of the dollars raised, so it's a $500 million transaction, 5 million of assumed fees to all the lawyers, bankers,
Okay.
financial advisors. What I'm saying is the tax, there's an investor on the other side, the intermediate bank, is, they're not doing this out of the warmness of their heart. They want to get a best deal possible. They could go and borrow money somewhere else at 6%. They're gonna do this deal at, I'm making up